Welcome to Plead the Facts, presented by KI Legal. On today's episode, KI Legal co-founder Michael Iakovou and senior associate Matthew Zwirren are joined by Rob Pecha, aka 1031 Rob, and founder of 1031 Rob LLC, to discuss everything you need to know about 1031 exchanges.
Welcome back, everyone, to Plead the Facts, presented by KI Legal. I'm Mike, my senior associate Matthew Zwirren, and the infamous Rob Pecha, 1031 Rob. If you are on LinkedIn and you are a commercial real estate investor, operator, buyer, seller, you've definitely heard of this guy because he's everywhere, and for a very good reason. I've been following Rob and his work in the 1031 space, and he'll explain to you a lot better than I can for the last couple of years. And you've really launched yourself into this, I guess, nuanced space of commercial real estate, and for that I applaud you. So many times you see general practitioners, jack of all trades, master of none, and you've kind of gone the opposite route, and I commend you for that. And why don't you tell the audience a bit about what you do and yourself as well?
Sure. So 1031 Rob, the world knows me as that. Very few people know my last name, so I'm kind of doing away with it because my brand has a stickiness to it. But obviously I call myself that because I help people navigate 1031 like-kind exchanges. I get a lot of, 1031 Rob, are you in radio? 1031 Rob, you must do Halloween promotion. I deliberately create mystery around my moniker. It starts a conversation. Sometimes people think I'm the wrong professional at the table at this thing called a 1031. Sometimes they think I'm a real estate attorney. I'm not. Sometimes they think I'm a QI. I'm not. I'm not even a real estate broker, and I'm not a CPA. But I align myself with all these people. So the reason I planted roots in this space, Michael, and really launched this brand is because I realized it's very underserved. There aren't many people that are like me doing this, even fewer that are like myself. So me, I'm very quality-centric with people and products that I recommend, and I have a very specific way of doing things. I operate best in one discipline, and that's why I went so deep in this one space. I could sell a lot of stuff. I choose not to, because me personally, I operate best in one discipline, and as you said, I find people today want a specialist, not a general practitioner. It's a fun space. It's a clever tax code that's been around for over 100 years now. It's super, super powerful. And the best part is many, many professionals, high caliber professionals like yourself, I'm sitting with right now, just aren't aware that this was created like almost 18 years ago. So it's not like it just came out and word is getting out there and it's this big secret. It's been around for a while, and people should know about it.
So before we jump into Delaware Statutory Trust, in 30 words or less, if you can, what is a 1031, so macro level, 1031 deferred exchange?
Okay, so a 1031 like-kind exchange was created in 1921, started with horses and land. Basically, it's a tax code that says if you sell investment property, you can roll those proceeds into something else. Why would you want to do it? Uncle Sam is not going to slap you with the capital gains tax, so it's frequently a big savings.
Sure. And then within the 1031 space, you've kind of hyper-focused your practice, right, and what you do and how you help people. Why don't you explain that to the audience?
Okay, so yeah, to go deeper on the 1031, many of you know from LinkedIn and other sources, I call myself your 1031 exchange quarterback, and I do that very deliberately. People are like, why, Rob? Are you so into football? I'm actually not. Admittedly, I'm not. But I do call myself that because at the end of the day, forgetting about Delaware Statutory Trust for a second, I make sure people understand the timelines and the rules inherent to 1031s. There's a lot of misnomers out there, misconceptions. First of all, I make sure people understand what is a 1031, like I just said. Why would you want to do one? Who do you need in your corner? You know, when people say, what's this thing called a QI? I say, well, if you never talk to me again, please make sure you get one before you close. Mm-hmm. Make sure they understand the timelines and rules, because the timelines and rules of 1031s are very strict. You have this 45-day ID and 180-day close. A lot of people run into trouble in that 45-day. So it's all the hand-holding that needs to be done, so they squeeze the maximum benefit out of this 1031. And as I said, I pull up a chair, I align myself with their advisory board, because the 1031 is a symphony. You need all these people working hard for you. Mm-hmm. Your real estate attorney, your CPA, your qualified intermediary, your broker to get you top dollar. And then possibly me. I mean, I pull up a chair at the table to infuse certainty, because what I do is going to give the investor more options and greater confidence inside of that transaction.
Okay. So obviously, typical, going back to the 45-day identification part of the 1031, right? We have the 3-property rule, 200% rule, and then there's a third one too, right?
95% rule.
95% rule. 95% rule. What, remind me what that is, because I actually have never had a client that elected the 95% rule.
95% rule, and by the way, this falls on the QI side. So the QI would typically advise the client which identification rule works best for the client given their situation. Most of the time, the rule of 3 works. That says you can name 3 properties irrespective of value.
Yeah, that's the one I typically
usually
see.
that fits, right? Because they're looking at one thing and they're laser focused on something. But there is also the 200% rule and the 95% rule. 95% rule says you have to close on 95% of what you identify.
Understood.
So it's a little more uncommon, but it does allow you to name more than 3 properties. So depending on what an investor is looking at, sometimes you have multiple location assets. Sometimes the 3 property rule doesn't fit. So you have to be conscious of that. But again, the QI, if you're dealing with a very reputable one that knows what they're doing and have been doing this for a while, they'll be able to guide you in terms of which identification rule is more appropriate.
And the 200% rule allows a 1031 buyer to identify many different properties so long as the total sum of the value of those properties don't exceed 200%
Correct.
of the relinquished property.
Correct.
Yeah, so I can't stress enough, Rob, to your point, how important it is to have a qualified intermediary handling that portion of the transaction, because I've seen it before. A lot of these 1031s, these after the second leg of the 1031, IRS will come back a couple years later and potentially audit the transaction. So it is important that everything is done timely, papered the right way. They don't take possession of any of the proceeds on the first leg of the 1031. I hear horror stories, and I'm sure you can probably share one or two.
Absolutely, and to bring to everyone's attention who's not aware, the qualified intermediary space does not have any regulation. I can literally grab this table, take it out to the street, put a tablecloth on it, write QI, and I'm in business. So you want to be careful who you're working with. You want to work with somebody who's nationally recognized, bonded, has been doing, hopefully this is their core competency in their business, and have been doing this for a while, because I will tell you they're not all created equal. If you're talking to me, again, I'm not a QI, but I will recommend one that I work with very closely, and that I'm familiar with, and that I know does the right thing. So you want to be very selective, again, with your advisory board. It very much is your advisory board, because if you want the max out of a 1031, everybody has to play their part to a T. And you want your qualified intermediary to be top notch.
Couldn't agree more. Let's jump right into 1031 DSTs. What is that? Why do I need it? Why do I care?
That's my secret sauce. I mean, that's at the end of the day.
Can you share it?
I can share it.
Okay,
At the end of the day, that's all I do.
That's how you get paid, right?
Exactly. If you buy one of these, my family gets paid. If not, I'm still going to be your quarterback. That's a promise. That's my promise to everybody out there. But what I operate in specifically is this world of 1031 DSTs, or Delaware Statutory Trust. It was a structure created in 2004. 2004, IRS gave it its blessing, said if you package up real estate as a DST or Delaware Statutory Trust, it qualifies. It's considered like kind to everything else that you can chase within that 45-day period. So that means right up there with duplex, triplex, mineral rights, whatever else qualifies under like kind is my ready-to-go menu. I always have a ready-to-go menu of various DSTs from various sponsors. I don't like them all, by the way. I'm very selective, so I'll whittle that down. But I always have a ready-to-go menu of these DSTs in different shapes and sizes. So we have retail, multifamily, industrial, self-storage, office space, many different asset classes to choose. I like to lead with what the investors know and like. For example, if they're coming out of multifamily, okay, we'll look at multifamily. If they like certain states, we'll start there. But I always fall back into what they need from an exchange standpoint, because at the end of the day, they're doing this for tax reasons. They want to get the maximum savings. So I'll make sure we fall back onto that. And again, very quality centric with regard to the sponsors I recommend.
Rob, let me ask you, does a 1031 participant need to stay within the same real estate asset class? So you mentioned there are different types of Delaware Statutory Trust asset classes that package up various types of properties and offer them to 1031 participants. If you are selling a multifamily building, do you have to go into a multifamily associated Delaware Statutory Trust, or can you
Is that
mix
considered
it?
like kind?
So that's a question I frequently get. A lot of people out there do think like kind literally means like kind. So they tell me, okay, I'm selling my brownstone in the Bronx. I guess if I want to do a like kind exchange, I have to roll into another brownstone somewhere else. And that's not actually the case, though you could do that as long as it's held for investment purposes. You can move from warehouse to multifamily to student housing, retail to anything in between, as long as it's considered like kind and on that list. And again, these Delaware Statutory Trusts are.
Okay, so again, reverting back to the kind of the nuts and bolts, the overarching, I guess, opportunity. is there like a pitch deck that gets shared the same way you would if you're an investor looking to invest in a company, or maybe like a co-op, or how does it work? How do you underwrite the opportunity for your clients?
So plenty of layers of due diligence here, by the way. Me, technically, I'm a securities broker. I'm registered with an independent broker-dealer out of Chicago. I carry a Series 7 and a 66.
Got
You
it.
need a Series 7 to sell these Delaware statutory trusts.
Okay.
So it's securitized real estate. It's packaged up as securitized real estate, and you need a Series 7 to sell it. That being said, I have plenty of SEC and FINRA oversight, so we have to be very careful how we represent these things. They also come with private placement memorandums that are literally like that thick, have every type of disclosure in there, all the SWOT analysis, third-party reports, environmental reports. Honestly, way more than any investor typically cares to read, but there's plenty of detail in there. So there is a lot of work that goes into this to making sure they're set up for success. That being the case, on the front of every PPM, it's going to tell you principal subject to risk. Now, the good news is investors are already used to this, subject to the same risks they know.
Are these accredited investors only?
These are only accredited investors.
Understood.
Correct.
Can you tell, again, this is something that we know what accredited investors are, but a lot of people don't know what that means.
So an accredited investor, you can meet that definition by two ways. You can either hit an income level of $200,000 for the last 2 years, $300,000 if you're married, or from a net worth standpoint, be worth $1 million or more, not counting primary residence. So you can meet that definition one of two ways, but DSTs are exclusively for accredited investors.
Okay, that's important.
But getting back to your point, plenty of scrutiny that goes into this. Again, SEC, FINRA oversight, and it all comes down to the stewardship of the underlying properties. I always say that's key. So, I have these conversations with clients. I kind of navigate expectations of where the rates are and rates of return. And sometimes you get a little pushback maybe a week later. I sort of navigated the conversation to go in the more conservative route. And I say, look, this is what you pay for quality. This is what it's paying. A week later, they'll Google something, it's paying an 8.5% cash on cash. How come you didn't tell me about that? Well, who are they? How long have they been doing this? Do they have necessary reserves? Something is at risk there, making this more risky or less attractive to you. So I always encourage my investors, the DST, the engine under the hood, has to do what it's designed to do. And what's that? Satisfy your exchange quickly and easily, pay you to wait for the holding period, and then hopefully that initial investment comes back with friends down the line. If you try to squeeze a little more juice out of it, just for the sake of an extra quarter or half a point, it's just simply not worth it, in my opinion.
Yeah, that makes sense. So let's run a hypothetical here. I think I sell a property, okay? $500,000 is left over. My debt, like the mortgage that I paid off, was $1 million. How does that work? What do you do with that then? Right, I have $500,000 in the QI's account, which is, I guess, what was left over after expenses, payoffs, etc.
Well, it does settle, sure.
Yeah, and then I have, on that deal, there was $1 million of financing that was paid off, debt, mortgage, right? How does the debt get rolled into these DSTs?
So that's
Equity and debt.
So that's a nice part about these DSTs. And then, of course, I'll want to circle back to my other profiles that these DSTs are good for. But that is one that's particularly useful, is that sometimes you have investors coming out of situations like this. They have a higher
And
leverage.
sorry, just on that point, right? It's 2022, interest rates are up the wazoo. We don't know where the world's going. You have office, which I just read something today on, I think it was on Business Insider, which, I know it's Business Insider, but about the office apocalypse, right? So there's a lot less attractive, hard, real property assets right now, but people who are on the second leg, they're looking to replace their property, right? They may be taken aback. I might just pay capital gains on this, because what am I going to go into that's going to make sense, especially with rates in the 8s and the 9s? So
Right, and then you run into the issue of, do investors qualify for something that may be that high? Maybe you're doing a 1031 exchange, you're coming out of a position that has 60%, 65% leverage. With the rates and possibly with the investor's credit situation, you may be stuck. You may not be able to do anything there. One nice thing about the Delaware statutory trusts is, because they're so modular and they have different amounts of LTV baked into the deal at the sponsor level, it's very easy to blend those and get the sweet spot that the investor needs. So, and it's also non-recourse to the investors. So we have anywhere from all cash deals that have no leverage in it. So you have exchanges where investors don't actually need the leverage, they're in all cash. Sometimes they will take on leverage because the CPA can use the added depreciation schedule to help them out, but if you have all cash deals, we have those. Some of them are, well, a lot of them today are between the 30s and 40s LTV. 5-6 years ago, it was common to say, mid-50s.
Mhm.
And then we have, on the other side of the spectrum, we have something called zero coupon offerings. They're in like the high 70s.
Mhm.
And you can blend these programs together. Zero coupons don't pay anything, by the way. There's no cash flow. It strictly services debt. But my
Okay.
point is, I have everywhere from all cash to zero coupon and then the middle. And you can blend together to get that sweet spot. So if an investor has concerns about, maybe my credit's not good, or how am I gonna qualify for this, or rates, this, that, these are already prepackaged. These are 1031 exchange ready with a huge green check mark ready to go. I don't have any closing risk. So if an investor has that concern, it's certainly worth a conversation.
Got it. And just, again, can you clarify what you mean by blend between the two different
Sure,
opportunities?
Sure, so because typically the minimum for Delaware statutory trust is $100,000 for an
Okay.
investor to invest, I can.
And that's just something set by the PPM, or that's just
That's set by the
statute?
individual sponsors.
Got
Typically,
it.
the cash investments, if you're coming in as a cash investor, you can do these in a non-1031 scenario.
Okay.
Those amounts are typically lower, but usually the threshold is 100,000 or above.
Understood.
So again, anything over 100,000 or more, I can deploy into these. Say you have an investor doing an exchange for $500,000, you can go into 5 of them, you can go into 2 of them. You can blend it any which way. But because they're so modular, you're not really chained to just going into one. You can mix them together.
And so does a percentage of the debt that the sponsor holds on the property get allocated to that entity coming in?
Yes.
Oh.
Yes, and that's always something I watch is, there's always 2 targets inside of a 1031 exchange. 2 things you want to keep your eye on. Everybody gets the first one because it's easy. It's okay, I sold, now the dust is settled after closing costs, what's left sitting in the QI to be deployed? That's my deployable.
That's the 500,000.
That's the 500, everybody gets that part, that's easy. But
Now,
then,
the million, how does that work?
that's the mortgage. So if you retire a mortgage, and I get this a lot too, like, oh Rob, I paid off the mortgage at closing, it's 0. It's not how the IRS looks at it.
No.
It's still on the books as whatever percentage that was. And the idea with any exchanges with regard to those 2 components, equity and debt, you wanna go equal or greater. They say exchange up. So whatever your equity was, you wanna send everything out, every last penny. And whatever your mortgage position was that you retired, you wanna go into the same position or higher. Otherwise, in either one, if you fall short, you get hit with the boot.
Mhm.
Yeah.
DST
What's
solved that
boot?
pretty well.
What's boot?
So the boot is a relatively common.
We hate the boot.
Industry term. The boot is extra cash that you may not have been able to spend, that is garnered from the original relinquishment transaction that takes place. Usually it's in the range of, $300,000 or less, hopefully, if you've worked out the replacement asset properly. But that is money that if not spent, you will need to pay capital gains tax on. And so I know everybody's always trying to avoid the boot. Are DSTs a good option for somebody who may have a boot coming off of one of their 1031?
Absolutely, I'm glad you segued into that because that's another one of my profiles of investors that I try to look for. And it's kind of funny, no matter what that amount is, when they have that boot scenario and they're looking at a leftover, 100,000, 200,000, 500,000, I've seen 1.2 million. It doesn't matter what the amount is because the mentality at that point is, I have a successful exchange on my hands, I got my primary and or secondary choices, I'm happy, I'll pay the tax on what's left.
Mhm.
And the reality is, by using DSTs, they can actually put that money to work for them, get exposure to an asset class in their real estate portfolio that maybe they don't have, like industrial or self-storage.
Non-recourse.
Non-recourse if it has debt on it. Put that money to work, so it's gonna pay you something. Plus it has the opportunity for back-end depreciation down the line. Just a better use of the money. And as the advisory board, whether it's coming from you guys or the broker or the CPA, it just shows the client that you're looking out for their overall best interest.
No, I mean,
You're looking at the entire pie, not just, hey, let's get most of it done and we'll leave something behind.
It's incredible. I mean, this is basically a guarantee of a one-to-one exchange, right? Because if there is that, if you're coming into an asset for even I guess $100,000 or more, there's no reason not to use a DST, right? It really makes extreme sense.
It solves a couple problems. I mean, my former tagline before I came up with your 1031 exchange quarterback was, I would say 1031 solutions to 1031 problems, because that's exactly what DSTs do. We spoke about the LTV issue, and if you don't qualify, you need something higher leveraged and blend so that you don't get hit on that boot. That was one. We just spoke about the scraps, the residuals. There are 2 more. If you don't mind, I'll get into this
sure.
now. 45-day identification, let's talk about that one. I get this one a lot. I get people that procrastinate all the time They think it's a lot of time.
It's not.
And it's not.
It's really not. It's not a lot.
I don't know if it's so much you guys, but I know the brokers get the panic phone calls at the 11th hour. Like it's day like 41, 42, and they're like, oh, you gotta find something. There's that. Or they just put all their eggs in one basket.
Mm-hmm.
So they sell that brownstone in Brooklyn, they have their eye on something perfect in, I don't know, Queens, and they're just running and gunning for that with blinders on, not thinking about anything else. It's real estate, guys. You know, anything can happen.
Mm-hmm.
I've seen the long shot come through, and I've seen the sure thing fall apart.
Yep.
And everything in between. So one cool thing about DSTs, again, I told you, I have no closing risk, and I always have a ready-to-go menu. These rotate, they sell out, new ones will come out, some will disappear, and new ones will come online. But I'll always have the same high-caliber sponsors to talk about with quality product throughout the country.
Mm-hmm.
I have no closing risk. It's good to keep me in mind, particularly towards the end, because I can be a safety parachute for that 45-day ID. And what do I mean by that? Let's just go back to that first identification where we spoke about the rule of 3.
Mm-hmm.
Let's just say that fits in the scenario. Investor sells that brownstone in Brooklyn. They're looking at something else. It's perfect. It's in Queens. Same thing. Happens to be another brownstone. Doesn't need to be, right?
Mm-hmm.
It's literally like that. But they're just looking at that one thing. They have no backup options to that. So what I say in scenarios like that is, as you get closer to the end, it may be prudent to take a look at my menu and see what's on there. Name something as a backup position just in case. Because I've literally been a backup to a backup.
Yeah.
I had a client in Brooklyn that he had 2 options. He swore up and down either one would work, but he had the foresight to say, okay, let's name one of these as a backup just in case. And he even told me, he said, Rob, I don't really want this, but it's real estate. So something happened to the first, something happened to the second, and in the end he was happy he had the DST as a backup to preserve the exchange. Because if you mess it up, you owe the tax, and what was the point really anyway?
Mm-hmm.
So it's good to name these as a backup. It doesn't obligate you. It just kind of sits there at the ready to save the exchange if you need it. So 45-day backup, it's great as that. But I would say 97% of my clients fall into what I call category 1, which are people that don't want to deal with tenants, toilets, and trash. If you're looking to ditch that, you know, they're older people, 60s, 70s.
Mm-hmm.
They bought the property a long time ago for next to nothing, 25, 30 years ago. Now they're looking to sell, so they're probably looking at a big capital gains tax.
Mm-hmm.
Possibly, quite likely, even depreciation recapture. So when you consider all these numbers, chances are you guys, as the real estate attorneys or the CPA, saying you have to do the 1031, otherwise you're going to get killed with taxes.
Mm-hmm.
Yeah.
And for the most part, that resonates with these investors. They say, yeah, that sounds good. But what about the other side of that coin? I have to be a landlord again, I have to deal with tenants, toilets, and trash, all the headaches, the responsibilities of that. If they're not looking to do that, but still capitalize on the tax benefits, DSTs could be a home run for them as well. Because you get institutional grade properties, again, you can choose from all different types. There are no managerial responsibilities on the investor side. So you're passing it literally over to the sponsor, which is hopefully a good one, to kind of run the show for approximately 5 years. That's the industry average. Now, it could be shorter and it could be longer. From a compliance standpoint, we're trained to say 7 to 10 years. Just to manage expectations a little longer, the industry average falls on or about 5.5 years. Conversely, we've seen shorter. So if the sponsor can get a great offer on these properties and offload them sooner, that will trigger a liquidity event, and investors participate in the back-end appreciation on that.
Let me ask you about the flip side of that coin, where you have 1031 clients who come to you who are active managers. Maybe they, in addition to owning real estate, they manage their own real estate, or they have a management company where they manage their real estate and other people's real estate, and they need to get into a DST. They didn't have a great option for them to get into something that they could manage, or geographically it was outside of their main competency location. How do you speak to them to get them okay with not having the control that they would normally have over a property they would invest in?
But I will say, Matthew, I don't try to change the profile. So if they're more hands-on, if they tell me, Rob, I can typically get IRRs of 18% a year, I'm like, that starts to move away from me pretty quickly.
Mm-hmm.
So I like to manage expectations that these are for very specific clients, sort of those buckets I went through, the people that don't want to be landlords anymore, or have a 45-day issue, or maybe matching a debt issue, the LTV, or just have residuals. Those are sort of my profile.
Mm-hmm.
If they're more hands-on and they want to be hands-on, I even tell them, DSTs are so passive, it's going to drive you nuts. I've had a client tell me, I love when the tenants pay rent late, I drag them out to the street, I punch them in the nose. I'm like, don't do this. It's going to drive you nuts. It's so passive. So the profile has to be correct. And that's why I said in the beginning, I'm not for every exchange, but I think every exchanger should know that this is an option.
So what kind of returns do you typically see in the market on these DSTs?
So they're creeping up. Obviously, they've come down. Years ago, to quote the same sponsor, same high caliber, top tier sponsors as I call them, in the space, it wasn't uncommon to quote in the 5s and 6s. Now that's come down to about 3.5 to 5. So I'm sort of in that range. Anything outside of that range is likely a newer sponsor trying to grab market share because they're competing with these bigger guys. But as I said, something is at work there. They don't have the reserves on hand. They're overestimating occupancy, underestimating taxes. Something is different there, because if you have an industry leader that's at half the cash on cash number, it has to come from somewhere. Right, exactly. So I like everybody to sleep well at night, myself included. I say set this up on a path for success. Again, fully understanding that these do have their risks, but they're used to those risks already. So changes in vacancy, illiquidity, inability to collect rent, it all applies here. The only difference is who's at the helm, and that's why you want them to be very good at what they do.
Rob, let me ask you this question. You spoke a little bit earlier about using a 1031 to leverage up. What sort of benefit does that provide in the 1031, and how can people utilize the 1031 to take an asset where they may have been a bit cash heavy in the loan to value aspect of it into getting into a more valuable, bigger, different type of property that presents them with more of an upside opportunity while utilizing the benefits of a 1031 to get there?
So what I see sometimes, and it's becoming more frequent, are all cash 1031s. So investors are selling properties, there's no mortgage on it, so the LTV is 0. So they don't have that component to worry about. They don't have to match any 45, 50% LTV, whatever. So that's not there, but a lot of them will choose to take on leverage for the purpose of offsetting net income. So with the presence of a new depreciation schedule, say they come out of an all-cash deal, now they take on a DST with leverage, whatever that amount is, the CPA can actually use that to help offset the income. It's a tax play. I don't give tax or legal advice, so I'll just throw that out there.
Disclaimer.
As far as I can speak to that, but it does happen. So though it sounds counterintuitive, like why would I take on debt if I don't need it, there is a value to it.
Very interesting.
So theoretically, you could go from the $500,000 all cash property, and if you wanted to, in today's market, leverage up to something that's around maybe $2 million if you wanted to include the 75% of the value of that $2 million property in debt. So you can take a property that was worth 500, or an initial property that was worth 500, and essentially without paying any tax on the gain, turn it into a $2 million property.
Sure, you can always lever up. You just don't want to go the other way.
Right.
And so in that example, is there any, I guess, qualifications that you as a seller need to show, whether to the sponsor or to you? Are there any limitations with that levering up?
Are there any limitations in terms of what the individual investor can do?
Yeah. The same way a bank would look at it, right? They're qualifying you, maybe they don't want you to go 75 LTV. Is there anything restricting that, whether it's in the PPM regulations?
So not from me, because the LTV is underwritten at the sponsor level.
Okay.
Whatever it is, that's on them. My responsibility is as a financial advisor, Series 7 license, is to make sure it's suitable. So number one, make sure that they're accredited investors. Make sure I'm making recommendations based on what they need, and make sure it's a good fit. So I, as a financial advisor, need to do everything in my power to make sure I'm matching it up correctly. In terms of, should they be taking on this much leverage or not, that's not my call. But if my broker-dealer did approve something with a high enough leverage and it worked for them in their scenario, then that would be fine.
Going back to that liquidity event, let's say there is a 5.5 year runway on the sponsor's plan. Walk me through, I guess, how the investors are made whole at the end. Here's a check, we're done, and your 45 days start again?
Yeah, so it basically, Michael, brings them back to square one.
Yeah.
So they sort of cycle through, let's just call it for sake of argument 5 years, which is what we typically see. So they got into these DSTs, or one DST, let's just call it one. They got into the DST, it rode out for 5 years, so it paid them that mailbox money for the duration. And then on the back end, which is called the liquidity event, all that really means is that the sponsor was able to actualize a great deal on the property, so they're able to sell them for a good price. Investors participate in that, so they get their share of the back end depreciation there as well. And then what do? Depends on their scenario. They can pay the tax at that point, just like they could have in the beginning. They could pay the tax on Uncle Sam, he loves that one. You could do the DST again, you could go into something else, like a triple net, or find something on your own. The choice is totally theirs. And by the way, that's another reason I don't like to over-diversify my clients into different DSTs. I mentioned before the minimum is $100,000. As soon as I say that, I do have investors say, hey, Rob, I just told you I have $1 million. Let's go 10 different ways. You get diversification, that's good, right? It's good to a certain point. but it also gets costly from an accounting standpoint.
Mhm.
It gets messy from a qualified intermediary standpoint because you'll have different liquidity events happening at different times. And most importantly, it's self-serving to me, because even at those lower amounts, your 100,000 now becomes, I don't know, 115,000 down the line, or 120,000. Even with those types of appreciation, they're not gonna have any other choices besides DSTs to go back to. Though I appreciate it, I don't feel like I should be their only choice. So diversification is valuable, it is a good thing, but I always say in the world of DSTs, don't overdo it, because you're gonna limit your options down the line.
And you mentioned repeat sponsors. Who are some of the big names, sponsor-wise, that you've placed sellers in historically?
So I'm a big fan of Inland,
Inland.
Pasco,
Got it.
Cantor Fitzgerald.
Big name.
Name. And geographically, where do you see a lot of these sponsors transacting? Is it the southwest, southeast, like where?
So they're typically, Michael, in the secondary and tertiary markets. So we
Right.
never see anything in New York or Miami or LA. They're always in like the Carolinas or Florida,
Midwest.
Texas, Midwest. Yep, someplace where the sponsor can acquire that property. Keep in mind they're professional property management companies, so they're running operations day in and day out. And they want to be able to do minor upgrades. They can't do major. Minor upgrades to the point where they can sell those for a profit approximately 5.5 years down the line. That's the goal. That's the goal of any DST, doesn't matter who it's by. So that's kind of what they want to do. But they cannot actualize something like that here in markets we're in New York.
Do you find you often have to match your clients with a particular sponsor? Or are there better, are there sponsors who are more communicative to their investors? Or are there sponsors who want their investors totally hands-off? Or are there sponsors who, are willing to engage with investors? Are there those differences amongst DST sponsors?
So with the DST sponsors, much like the QI comment I made earlier, they're not all created equal. Some are much newer, they're trying to grab market share. Some have been around for a long time, they have proven track records, and they've weathered tough storms like pandemics and things like that. And I'm very big on that. For me to take on a new sponsor, it's a little difficult because there's nothing to fall back on yet. They're not necessarily a bad outfit or even a bad sponsor. They could be excellent, but just having that security of a track record, to me, is important. And I always tell my clients, if you let me drive the bus, if they come in and they have a need, or they say, this is exactly what I want, or this is where I want to be, we'll start there, and if it makes sense, we'll proceed. But I always say, if you let me drive the bus, I'm going to start with the top tier sponsors. Yes, they're going to be more conservative. Yes, those numbers are not going to be crazy and knock your socks off. But keep in mind, big picture, we want this thing to do what it's supposed to do.
So, during the lifetime of the seller's involvement in the DST, they don't have guaranteed mailbox money, but they, pursuant to the
Right.
PPM, they should have a pretty good indication of what type of money they are going to be generating.
Right.
That said, on the liquidity event on the back end, on the exit of the sponsor, the sale of the sponsor, is there any, kicker that would go to any of these DST purchasers, or is it again kind of static along the way?
It's subject to whatever in the PPM.
Got it.
Different sponsors have different ways that they allocate, but investors do participate in those back end gains.
Okay.
So keep in mind, these sponsors want to sell these for a profit. Investors do participate in that.
Okay.
And all it really means is that the chunk of money they put in the beginning is now bigger. Because
Yeah.
we're not talking about that paid to wait money. That was paid to wait money.
Yeah.
If we're talking about the initial investment, comes back with friends at the end.
Yeah.
And then it almost makes them need to do a 1031 even more, because now it's like your capital gains tax is even bigger. And they say in our business, and you guys have probably heard it, it sounds corny, but everybody gets it. They say kick the can till you kick the can. And that just means just keep rolling. It doesn't have to be with me. Again, you could do DSTs and do a triple net the next round. Just keep deferring, because that's the only way you can basically eliminate the capital gains. If people say, wait, Rob, stop right there, it's tax deferral. The investor can't actualize the benefit in his or her lifetime, but the heirs, as it currently stands, still around, will get the stepped up basis, which is a huge benefit.
That step up.
Yeah.
And you do have the benefit of getting into assets that can provide you more cash flow on a monthly or annual basis, which is, that mailbox money that we've been speaking about, and that's a way that you can realize a lot of the benefit of doing the 1031 exchange is by getting into an asset that can produce more cash flow for you on a monthly or annual basis.
Exactly. In addition to diversifying not only by geographically but asset class wise, you could potentially move into something that's cash flowing you better than the way you manage your building or your investment property.
Yeah, and a lot less headache. I mean, it makes it really, like I said before, it really does make perfect sense. What do you see the future of DSTs, the 1031 space? I mean, I know there's been a lot of speak out discussion at a federal level about 1031s. Last year, right, there was talk about, are they gonna eliminate the 1031, which obviously would not have been good for many people's businesses.
I'd have to change my name outright.
Yeah, that would be difficult.
Tell the IRS, keep it.
Yeah, but seriously, what do you see the future, as we're entering into this recession and whatnot? I'd love to hear your thoughts on that.
Sure. So first off, 1031s, and I get asked this a lot, they're alive and well. So though we have retrading going on right now because of the rates and stuff, investors, when they're ready, if the circumstances are right, they're ready to offload that multifamily building or whatever it is, they'll move forward. Because by the time they talk to me and I'm inserted into the equation, they've already made their peace with whatever rate they have or whatever their specific numbers work out to be. So I will say that they are happening. It's sort of shifted a little bit into like what would be typically a surge for me September, October, because of the rates and the retrading has kind of moved into December, January. So they're still happening for the same reasons that they would have happened a couple months ago. It's just because of the uncertainty of the rates, they're sort of getting stalled. But if investors are motivated enough to move forward and those reasons were correct, they're going to move ahead.
Let me ask you this, when speaking about rates, is there a time limitation on when an investor can come into a DST? I know you said that sometimes the runways on these are around 5 to 7, possibly 10 years. Can you come in as an investor in the 3rd, 4th, and 5th year? Or do you have to get in within the first 6 months of the property's purchase? Or how does that work? Because
glad you mentioned that. Yeah.
So you get a benefit
so
of a
Some
rate
type of
from
seasoning or anything like you would have?
So basically they'll have a raise, like a sponsor, like an Inland will have a raise. That may be a $200 million raise on a multifamily property. It could be a $20 million raise on something else. It really just depends on the size of the offering. The larger offerings will stick around a little longer. The smaller will have a lot less shelf life. Once those seats are filled, it's gone. It doesn't come back. So it will never stick around too long. And again, depending on the size of the offering, it may be around a little longer or not. But once those seats are gone, they're gone. And they're never coming back. There'll be new offerings in rotation behind it, but those seats are closed. And then those investors are just participating in that program, waiting for the liquidity event to happen.
So theoretically, if you had a big raise that was around for, let's say 8 months, you could essentially be, as an investor in December 2022, getting into a property that has the interest rates on its debt at, March of 2021, or, whatever it might be, a significant time period in the past where you're getting a better interest rate than you would if you went to your average lender today to explore what the debt markets are like.
That's true. If you could find one that stuck around that long.
How long do you find them, even on the biggest rate, 200 million, how long on average do you find those sticking around?
Those could stick around about 3 months, 4 months.
Okay.
Yeah. If it's a smaller offering, much quicker. Just depends what the appetite is out there in terms of the investor's need.
So, is there a seasoning requirement with these DSTs the way you would have with traditional 1031s? Meaning you have to hold the asset for a year, right? You mentioned the smaller ones, $20 million. Have you ever seen in your many years of doing this, where an opportunity where a sponsor opens up for funding and investment, and then maybe they sell the property month 11? Did that ever happen?
No, because it's part of the 1031 rules. It says you have to hold it for investment purposes for at least 2 years.
Got it.
So, and that's part of the discussion I have with would-be investors or investors when they say, oh, Rob, can I park this money for like a year and a half somewhere? I'm like, first of all, that's not me. You're looking at like probably a 5-year time horizon, maybe a little longer.
Okay.
But be careful no matter what direction you take, because anything inside of 2 years, the IRS can contest and say that's not a legit 1031. You didn't hold it for investment purposes for 2 years, maybe the tax, and that's not a good thing.
Right.
So yeah, you do want to be in these things for at least that's considered the safe harbor. Again, in my world, it's probably going to be a little longer. I mean, we've seen 3 years, we've seen shorter than that, but you're probably looking at about 5 years, and you absolutely make sure you don't want to violate inside of the 2 years because of the reason that the IRS can come back.
Sure.
And then on financing affecting the sponsor, this short-term financing, let's say they have a 3-year loan facility, right? And then they refi, going back to your example, into a better interest rate. Do any of those, again, in your experience, have you ever seen any of that extra cash being passed down to the investors? That's something that the sponsor would typically participate in.
No, they'll get bumped. I just got an email like that 2 days ago saying that it's actually performed better than what was projected in the PPM, and this is what the investors can expect.
Nice.
That's incredible.
And are there any different, I guess, I want to call it stock allocations, like Class A, Class B, but have you ever seen any variance on that depending on when you invest in a sponsor? Where everyone's kind of the same?
No, everybody's the same. Keep in mind, these are fractional ownership interests
Okay.
in whatever it is. So student housing or industrial, whatever. So everybody's kind of occupying a seat. What their fractional ownership interest is depends on
Their
what they
investment.
invested and
Yeah.
what the size of the offering is.
Got it.
But that's it. Everybody's literally sitting in a pool, of other investors. Everybody's collecting their share of the rent roll for whatever it is. And that's it. They're just waiting for the ride to end. No matter what DST, no matter what sponsor you're talking about, they all act the same way.
Throw a little bit of a curveball at you here.
Okay.
Reverses.
Reverse 1031 exchange?
Reverse 1031 exchange, something that the IRS revenue ruling in, I believe, 2004, gave their blessing to DSTs. Can they be utilized in a reverse 1031 exchange? Are they beneficial in any way, shape, or form for somebody who may really want to buy something before they sell, or something to that effect?
Meaning purchase the DST or DSTs first, then offload the investment property?
Right. So essentially, you would have a exchange accommodation agreement with a qualified intermediary. They would take your fractional ownership interest in the DST, hold it until you sold your property that you wanted to relinquish, and then that investor steps into the DSTC.
It's actually an excellent question. I don't BS people, so I won't pretend like I know it. That would be a question definitely for the QI, and a QI that, this is their core competency and does a lot of these would certainly know. I can think off the top of my head of a gentleman that would absolutely know. But yeah, and those are much more expensive, by the way, the reverse exchanges.
Yeah.
Yeah.
Whereas your straightforward typical exchange will be anywhere from like 800 to 2,000. Reverse exchanges typically north of 10,000.
Yeah, I've seen quotes 7,500, 10,000, 15,000.
There's more
in some
teeth to it, so
instances.
more work.
Yeah, and I think the QI's got a little bit more skin in the game there. 'Cause
Absolutely.
in a lot of instances, they are holding title for the investor or the 1031 participant for a decent period of time while
Sure.
they're looking to relinquish, so.
Sure. But going back to your question, it's definitely interesting, and I want to know the answers. I'm going to try to find out.
All right.
If you find out, we'll post it.
We'll
in
do an addendum?
Yeah, we'll post it in the
Okay.
below the
Take a look
link.
in the comments for
Comment
the
section.
reverse 1031.
I mean, I've never personally seen it, not in my world, but it sounds like it would work, but I wouldn't want to make that call.
Over here, I've written down the impact of Biden's 2023 budget proposal regarding 1031 exchanges. Thoughts?
There was a point a few months ago, Michael, I was getting a call about this every day. Like, people that don't even know what 1031 is, like, oh, what's happening to it? It's been threatened for decades, and it's been around for over 100 years.
Mhm.
And it always survives. This legislation gets tabled, they miss deadlines. It always happens the same way. Sometimes they shoot more hours at it and sometimes less, but it always survives for a very good reason, because the last number I heard was 57.3 billion. It generates 57.3 billion of revenue. Those are all 1031s, not just DSTs. So all 1031s in a given year, and 27 billion of that is jobs, labor.
Wow.
So it's a big number, and then,
Yeah.
they're always trying to free up the budget, or let's limit the 1031, let's cap it out at $500,000, which would never work, by the way, nobody would sell.
Never work in New York, that's for
No.
sure.
So I get what they're trying to do, but it's like less than 1% of the overall, money they're trying to free up. And when you consider those numbers I just gave you, the good it does for the American people, think about it, it keeps jobs and it keeps money in motion in the American system. So to get rid of that, if you're gonna make it too painful for people, they're simply gonna just sit on the assets and it'll freeze the markets.
Yeah. On that point, though, if you had the legislative authority and power, how would you change the 1031 rule to make it better, to serve the real estate community better?
I mean, I think it works great the way it is now. 1031 Rob's happy with it the way it is now.
That's a good answer.
I know in 2017 they did away with the airplanes and the artwork, so there was an expanded definition of like kind. They got rid of that. Now it's just regular real estate. Maybe that was a good call. I mean, it's meant for real estate. That was sort of an expanded definition. It's kind of a little out there on the ledge, talking about artwork and airplanes and
Yeah.
other things like that. Keep in mind, this started in 1921 with farmers as a means to swap land and horses. And now we're talking about DSTs and triple nets and all kinds of different things. So I think staying in the real estate sphere, not touching that ancillary stuff is maybe a good call.
Could you ever imagine them allowing maybe people to do this with their primary residences or something to that effect?
No, because they have totally different tax treatment for that. That's section 121. primary residence exclusion, so
Mhm.
if you're married, 500,000 gets shielded from capital gains. If you're single, 250. And by the way, on that note, you can do split treatment 1031s. Say it's a brownstone, you live in the ground floor, you rent out the top three.
Mhm.
The top three would be in 1031 land, so you can 1031 those. The one that you live in would be split treatment, primary residence excluded, section 121. So you can actually use two tax codes to your benefit in the sale of a single property like that.
Yeah, so that would, partial 1031
Mhm.
exchange. How do they, I guess, delineate what percentage gets allocated to what? Is it just like on a per square footage basis?
Out of my pay grade.
Out of your pay grade?
That's the CPA to jump in on.
That's
Yes,
another, that's another good
That's
question.
it does go by square footage and the usage.
I mean, it makes sense.
And the
though.
frequency, yeah.
It does
absolutely.
make sense that those.
Absolutely, because especially in situations like that, and it may not be even, it may not be in my example, you know, you live in the ground floor, rent the top three, it may not be 25, 25, 25, 25, it may be designed a different way. That's a calculation I certainly want to weigh in on with the CPA.
Yeah.
Let me ask you about this scenario, and I've seen this come up from time to time, where you have a property that's owned by an LLC, several different members, and, you know, perhaps a good portion of those members want to sell and do a 1031 exchange, and some of those members don't. Any options that may exist for those members who maybe don't want to, or the members who do, to separate those assets and to be able to, you know, basically, you know, split it up and go their own way after the sale?
I've actually seen exactly that a couple times. You guys will probably be familiar with drop and swaps. I've seen LLCs successfully unbundle that way because for exactly that reason.
Mhm.
You have investors that want to do the 1031, you have investors that want to pay the tax and just be done with it, and that's a great way to sort of allow them to do that.
Got it. Yeah, we're seeing.
I
that
can't
a
tell you
lot.
more about that than that. Drop and swaps. Look it
Yeah,
up.
I've seen it in the tenancy in common context. You know, you take it from that LLC, drop it into, you know, a couple different, and everybody goes their own way.
Yeah, that's, again, it's like creative lawyering, going back to the advisory board. These are not run-of-the-mill answers to very difficult
Right.
questions, so it is important that,
So everybody has to play their part.
Yeah.
Right.
exactly, and always understand all the various optionality that you have, because the rule of the game is don't pay Uncle Sam,
Yeah.
right? If you can defer it, right?
Lawfully
Right.
and legally.
Lawfully and legally, yes.
If we've all done our jobs, then you'll squeeze the maximum benefit out of it. That's the goal.
I can't tell you how many times people complain, oh, he filed Chapter 11 bankruptcy, he took advantage of the bankruptcy code or the tax code. It's law, so it's shame on you for not knowing it, or shame on you for not having competent counsel or 1031 Rob by your side. So this has been great. I mean, in closing, how do people find out more about what you do and how they can potentially work with you?
Yeah, so with a nickname like 1031 Rob, I'm very easy to find. So during the pandemic, when we were all masked up, I had to be careful what I said. That's very Googleable. I actually come right up. So if you Google 1031 Rob, I come right up.
Mhm.
Obviously, my website is 1031rob.com, and my email is info@1031rob.com. Super happy to answer any questions. As I said, even if you're not a candidate for DSTs and that's not appropriate, let me be your quarterback. Let me help you bring it closer to the finish line. Maybe you use me as a backup. Maybe you use me for some scraps. Maybe it's just a free education, but it gave you more certainty in that transaction. I've done my job.
It seems like 1031s are a great vehicle for people to be able to build wealth.
Absolutely. As long as they stick around, and I think they're alive and well. So.
I think they will be. Thank you, everybody, for tuning in. Until next time.